Good morning, or good afternoon, or good evening, depending on where you're at. My name's Warren Duick. I'm coming to you from Vancouver, Canada. And welcome to Andersen Global's International PCS, International Private Client Services webinar. And we've got our colleagues here from around the world, and I'll introduce them to you later in just a moment. Our international private client service team is keen to bring you information, but also to build a network and communicate best practices throughout Andersen Global. My firm in Canada joined Andersen Global in 2018 as a member firm, and that was largely because of the depth and experience that Andersen Global had, and particularly Andersen in the US, which of course borders Canada, in its private client service skills. So there's a wealth of knowledge in this firm on private client service practices. And we want to find ways to expand that information and to get more information to you and present future webinars, both in a format like this, but also in the future in Las Vegas. And I hope you'll be joining us there at the Andersen Global Partners Conference. So we're going to talk today about top 5 tax issues when moving to various countries. And I looked at the countries here and I said, you know, there is a theme here. I mean, we have some of the largest countries in the world in terms of population. India's number 2 in the world with 1.4 billion. US is number 3. Brazil is number 6. Israel is number 100. And I thought, wow, gee, that's really low on the list. But Canada's 39, which is not very high either. But then I realized that Israel has a population density equivalent to India. So I thought that made sense. It has over 400 people per square kilometer. But then what does that do for Canada? Canada's average density is 4 people per square kilometer. And there's parts of Canada where it's way lower than that. So there's only a few countries like Falkland Islands and Greenland that have a lower population density than Canada. So we're part of the group. And I'll just briefly mention our names here and where they're from. Our team is Daniel Batega in Brazil, Vishwash Panjiar in India, Ilan Benali in Israel, Julian Nelberg in UK, and Deborah Crado in the US. And we're going to all chat about our subjects. There'll be time for question and answer. So if you have questions, please use the Q&A box and write those in. We'll deal with those at the end of the session. And we also have a brief survey too, and please complete the survey. It gives us an opportunity to identify new topics and move forward on that. So without further ado, I'm going to pass it over to Daniel Batega to talk about Brazil and tax there. And Daniel, just let me know when you want me to advance the slide and I can do that.
Okay, great. Thanks, Warren. Thank you, everyone. It's a great pleasure and an honor to be here and speak with you today. I hope this is the first of a series of several webinars and conversations that we have. I think it's very important for our practice individually and as a global firm as well. So I'll be talking about taxation to individuals. Warren, you can go to the first, if you may. I'll jump right into it with only maybe an initial disclosure or disclaimer. Of course, I believe this will be the same with all the panelists here. I'll be talking about the tax residence, right? So all the tax rates you'll find here and all my explanations will verse on the tax residence unless otherwise advised. I think it's very well. It might be good for everyone who's watching this. There's a main difference between the tax residents and the non-residents, which can be very easily summarized. The tax resident is subject to taxation on a worldwide basis, and the non-resident, the one who leaves Brazil and ceases, terminates the tax residence, is only subject to a specific taxation of earnings received in Brazil. So this is a main difference. I thought it was good to point that initially. Uh, so ordinary income in Brazil is taxed to the individual at the highest rate of 27.5%. This is the highest rate. We have only four brackets starting at 7.5%, and the highest one is 27.5%. So salary, incomes, bonuses, rental incomes, incomes I receive from personal service that I may render as a lawyer, for example, they're all subject to this progressive table with the highest rate of 27.5%. It's not that high of an amount. There are discussions in Brazil to change that eventually. You see, if you receive up to $400 worth of incomes, you're already subject to the lowest rate of 7.5%. And if you receive a little more than double that, 900, the equivalent of 900 US dollars per month, you're already subject to this highest rate of 27.5%. So it's not surprising that there are discussions about that, because even though progressive rates tend to be a little more fair to the individual, it's not the case to the very rich in Brazil. On the other hand, dividends that I might receive from Brazilian stocks, for example, or if you're a stockholder or shareholder you own a company and you receive the distribution of dividends and profits, this is tax exempt. Even though Brazilians might think that this has always been the case, this is not that old. This is started in 1995. And I believe that only Australia has something similar with the Franklin dividends, even though they tax it, but they give you the credit eventually. I know we have somebody in Australia, so I mentioned this to you specifically, but I don't think many other countries in the world would exempt dividends. Capital gains tax in Brazil is also subject to progressive rates. This is also something quite recent. As of January 2017, we've begun this progressive scales. It used to be only a single 15% rate, and now it's 15 up to 22.5%. So if you have a capital gain of up to roughly $1 million, you're subject to the 15% rate. And if you have something so 6 times that, up to roughly again $6 million worth of a gain, you're subject to the 22.5, which is the highest rate. Finally, just to have this overview of the Brazilian taxation, I mentioned there's a capital gain tax on gifts. It should be read as a state tax mainly. State and gift tax in Brazil, which is a state tax, and this awful pun means that it varies from state to state. So in Canada, you have the different provinces. For example, in the US, you have the states. In Brazil, we have different states also. So that means that state tax in Brazil has a potential of being 26 times different, because we have 26 different states in the country. They range usually at a single rate of 4%. This is the ordinaries. The São Paulo state, where I'm located, where the city of São Paulo is also located, has a single 4% tax rate. And this should be subject to changes. Since 2015, we have been seeing some changes in the states trying to raise this up to this 8% tax. Warren, if you may go to the next one. We've separated top 5 pre-move tax issues, and the ones regarding Brazil. I think the most important one, it's certainly the one that deals with residency. So if a foreign comes to Brazil, when does this foreign individual become a tax resident? It's very important to identify that and to see the obvious tax consequences. It all depends on the visa, first and foremost. So if a foreign comes to work, say as a director or a manager, he or she will have a specific work visa, and he will or she will become a tax resident in Brazil as of day one of physical presence. So the day the individual arrives in Brazil, he will be subject to the same rules applicable to all Brazilian nationals and tax residents. It might depend. Some types of work visa, you would count the days, which is pretty standard in the world. You would count 183 days, that magical number, roughly 6 months. So you would become a tax resident in Brazil. This will happen, say, if you spend that amount of time under a tourist visa, for example, or a business visa. And even if you are exempt to present a visa, say the European community largely doesn't request a visa for tourism purposes to Brazilians, and by reciprocity, we do the same. So say if an European individual would stay in Brazil more than 183 days of physical presence, he or she would become a tax resident and then would have to subject worldwide income to taxation in Brazil.
So Daniel, you got a couple more minutes here.
Yeah, thank you, Warren. This is why it is important, and it serves as a pre-migration planning of ways. Since we follow a cash-based system, it matters when you actually receive income, not to which period they may refer. Upon becoming a tax resident or moving to Brazil and becoming a tax resident, it's good to anticipate all the previous wages and allowances that you might have, because if you receive that before getting physically into Brazil, you would not tax whatsoever those gains or those incomes. It's important that even assets that you've acquired prior to becoming a tax resident, real estate, property outside of Brazil, stocks outside Brazil, investment funds, and the whatnot, if you become a tax resident and you sell them as a resident, since you acquire them as a non-resident, you would have a gain, but it will be considered an exempt gain. So we have a recent change on gifts and inheritances. As of this year, foreign received gifts and inheritance are exempt up to until the point that we have a proper act that will be enacted to cover that. This is a very controversial thing in Brazil, so I can discuss this a little further. We have 2 filings every year. Since we calculate our income taxes monthly, we adjust that in our income tax return, where we also report a list of assets, not for the purposes of taxing whatsoever. This is different. Say other countries, for example, Argentina, close to Brazil, they tax wealth, the patrimony. We don't do that. This is only for information purposes, but we have to report all the assets we have in Brazil and outside. I know this is a short thing. It's a lot of information, but I thank you for the attention so far. And later on, we'll have the time for questions regarding Brazil, if you have any. Thank you.
Excellent. Thanks, Daniel. I'm going to talk a little bit about Canada. And most people think about Canada, they think this is a really cold country, which is true for part of the time. But right now we're in a heat wave. I'm on the Pacific coast of Canada, which is very mild, but we have forecast temperatures up to 40 degrees Celsius. And I'm actually traveling inland later today, and it's going to be in the mid 40s. And that's Celsius, not Fahrenheit. So Canada's not only a big country and an empty country, it's actually can be a warm country too. So I'll talk a little bit about Canada and its tax rates and how some top issues with regards to taxation. Canada is a relatively high tax country. Now, Canada always compares itself to the US because, of course, we share a very long border with the United States. And so that's always top of mind for Canadians. And Canadians feel gratified sometimes when they look at places like Deborah's in New York, and they have high tax rates too. And New York and California have tax rates that are pretty close to equal what Canadian tax rates are. But the big difference here is, for example, in California, you hit the top tax rate of about 53%, but you hit it $1 million US. In Canada, the tax rate structure, you hit the top rate of 54% on 200,000 Canadian, which is worth about $160,000 US. So Canada has a tax rate that really stings. It does give preferential taxation for something called eligible dividends. Unfortunately, these are dividends only from Canadian corporations. And so it really encourages Canadians to invest in Canada, which maybe shouldn't be a surprise. Canada does have attractive capital gain tax rates, not compared to some countries represented here, but again, relative to the US, it's quite attractive. There's a lifetime capital gains exemption. I don't identify it on the screen here, but that can exempt up to $900,000 Canadian, or about 750,000 US of gains from taxation. Now, oddly enough, Canada Pension Plan, it's the statutory Social Security system, is actually one of the cheapest in the world. The maximum tax every year is $3,000 Canadian, or about 2,500 US. So if you're going to be a worker in Canada, it's an inexpensive place to hire people from the standpoint of pension plan costs. Canada is also, it's a really expensive place to live, but it's a cheap place to die. In that it does not have an estate tax. Instead, it taxes capital gains or unrealized appreciation at death. So that doesn't sound like a great tourism slogan. Come to Canada where it's cheap, it's expensive to live, but cheap to die. But I don't know if you have a lot of people coming to Canada for that reason. So I'll leave that to you. There are some hot button issues in terms of Canada, and that is, one of them is residency. Canada is a common law country, and it also uses the common law test of residency. That means Canada is very inclusive. In other words, if you have any contact with Canada, you're probably a resident of Canada under Canadian laws. And under that test, if you have a house, if you have a spouse, if you have kids or a job in Canada, you're a Canadian resident. You may be illegally present in Canada, but Canada would say you're a resident because of those provisions. Now, Canada has a very broad tax treaty network, and tax treaties actually tend to minimize the impact of that. But if you're from a country that doesn't have a tax treaty with Canada and people have connections with Canada, that can be a problem. So any residential ties with Canada will essentially make you a resident of Canada. Tax-free gains. Now, this is an interesting subject, and especially because the US has had a very hot stock market. There's a lot of initial public offerings out there, companies that you may know of like Snowflake and Airbnb and Coinbase and others that have raised a lot of money and made some entrepreneurs very wealthy. Some of these people realize that it's very expensive to live in the US from a tax perspective. And if they're not a US citizen and they move to Canada, they can end up paying no US tax and pay no Canadian tax on those gains. Because when they come to Canada, Canada only taxes gains after they arrive in Canada. So we've got people moving to Canada with gains of $100 million or more, which will escape taxation entirely. Now that sounds almost too good to be true, but it's a system where Canada doesn't try and tax those pre-residency gains, and if the U.S. doesn't assert the tax, or the other country where they've been, that's a pretty attractive place to be. It may be cold or big or empty, but Canada looks like a tax haven in those situations. We've seen a lot of activity in that particular area. Canada does not tax spouses as jointly. So it becomes very important in Canada who owns the asset. If you're married and you have one spouse has most of the assets or most of the income, all the tax will go to them. So one of the important things when you move to Canada is the issue of income splitting. How can we divide up assets between the spouses? And again, just referring to the stock market in the US, where people come from California, where it's community property state, and the assets are split between the spouses, this becomes a very attractive means of planning people in. And when they come from other jurisdictions as well, splitting assets between spouses becomes important. I mentioned earlier Canada Pension Plan. We again have people come from other countries, and Canada has a number of Social Security agreements with countries that have expensive pension plans. Now, if most of these pension plans, government pension plans, are government mandated, everybody's required to contribute to plans. If it was such a good investment, I'd say nobody would be required to give it because we'd be throwing money at these plans. But the fact of the matter is, these plans don't have very good returns. The only thing good about them is they're guaranteed for life. And you won't have very good return. But Canada has a very cheap Social Security plan, and it's relatively expensive. And when people come to Canada, even if it might reduce their benefits in the other plan, they're probably better off being in Canada Pension Plan, allowing them to invest in a non-registered plan, non-government plans. So Canada can be an attractive location in that respect.
2 minutes, Warren.
Thanks, Nicole. Non-Canadian assets. So Canada, like many other countries, has a tax regime that tries to tax or seeks to tax earnings outside the country. Residents of Canada are taxable on their worldwide income. And if they, for example, set up a corporation in the Bahamas or some other tax-free jurisdiction, they'll still be taxed in Canada on the earnings from that, even where they're not distributed. And this is what's called the Foreign Accrual Property Income Regime, or FAPI, it's known by its acronym. Like the US has a controlled foreign corporation regime and others. So that's our discussion about Canada, and we're going to switch to Vishwash Panjyar to talk about India. Thanks, Vishwash.
Thank you, Warren. Well, while India may have been famous for exporting talents and professionals all around the world, but it's also come out as an excellent investment jurisdiction. And with that, there has been a lot of influx of expatriates or people wanting to have their headquarters in India, and therefore wanting them necessitating them to move to India. So like everyone else, I am also going to talk about 5 tax and regulatory issues because India has an exchange control regulations, and that makes it an interesting mix. And it's important to understand those. So to begin with, let's understand the residency rules. Yeah. Can you, Warren, can you move to the next slide, please? We'll come back to this, but let's move to the next slide, please. So the residency rules are different for tax and different for the exchange control perspectives, and how the law behaves is also different depending upon your residential status. India follows a standard financial year, which is 1st of April to 31st of March. For that's the financial year, and that's the tax year for all purposes. From a tax perspective, if you're moving into the country and if you have stayed in India for more than 182 days, you become a resident in India. There's another way in which you can become resident is that if you moved into the country and in that financial year, that is from 1st of April till 31st of March, you've stayed only for 60 days or more. But in the preceding 4 financial years, if you've stayed for more than 365 days, you still become a resident in India. For example, if somebody, if let's say if a foreigner comes into India for 2 months, only February and March of 21, he should not become a resident in the financial year 2021, but he would if in the preceding 4 years from 1st of April 2017 till 31st of March 20, he has stayed in the country for more than 365 days, let's say only 100 days in a year. In all those 4 years, that's why the aggregate of the number of years he stayed is more than 365 days, he will still become a resident in India. Once you become resident in India, then first of all, India only has it's a federal system of taxation of income. There is no state tax on income, right? So once you become a resident in India, your global income becomes taxable. There is a small exception with respect to income which has been earned with respect to a business which has been set up outside India, but it's not probably relevant for this high level discussion. Because the income is the taxability is on a financial year basis, you can potentially have a situation where somebody has moved into the country, let's say in August of a year, and stayed throughout the end of the financial year till the following 31st of March. He would become resident in India, and the income that he has earned even before he moved to India, that would also become taxable in India. Obviously, there is a system of claiming foreign tax credit. So if that particular income is also taxed in some other jurisdiction, the credit of that would be available. India also has a very, very wide network of double taxation agreements. But even if there is a country in which with which India does not have a tax treaty, even then India provides a unilateral credit. So that's not a problem. Like in any other country, you may apply the tiebreaker rule that the treaty provides to determine which one is the home country and which one is the host country. But effectively, the credit of tax that you pay in a foreign jurisdiction on the same income would be available while paying tax in the country, in India. Now, coming to the exchange control laws, there are two fundamental differences in the residency rules and tax laws as compared to the exchange control laws. While, as you've noticed, the tax laws are pretty much based on the period of stay and of that particular year, right? In the year for which you're determining the residential status. Exchange control laws, on the other hand, moves completely based on intent, right? So if you're coming into the country with to take up an employment or to do a business or for any other purpose which kind of indicates that your period of stay in India is going to be uncertain, you become tax resident from day one, right? And and if on the other hand, if you're not come for these purposes, and if you've stayed in India for more than 182 days in the last year, not in that year, but in the last year, you still become a resident in India for exchange control perspective. However, if in that year, if you leave the country to take up employment or a business outside India, then again you immediately become a non-resident. It's pretty much dependent on the intent that you're going to of your stay in India. Warren, can we go back to the earlier slide or the 5 points? Right. So, as we've already covered the residency with respect to the exchange control as well as the tax. Now let's look at the tax rates. So, and the India also follows a progressive rate of taxation. There is what we call a slab rate of taxation, which depends upon the income that you earn. The tax rate on that particular slab progressively increases. The maximum rate that it goes up to is now 42.744. You attain this rate at actually much higher than what Canada does. If you attain that rate at what is, I think, US dollars, approximately 682,000 US dollars. So you come to that rate only at that point of time, and it progressively increases depending upon your income. There is a special rate for capital gains. Capital gains is gains arising out of alienation of or sale of a capital asset. That also depends upon the kind of asset and the length of stay. If you sell a Indian listed security, for example, or the tax rate would be as low as 10% if you've held it for over 2 years. Whereas if you've sold any other assets, let's say a house property or something like that, then you've held it for less than 3 years, then it becomes a short-term capital gain, and that's taxed at the same rate as your other income. So there is a graded tax for capital gains also from 10 to actually 30 or to your permissible rate. The rates that you see on the slide are with respect to long-term capital gains, which is the sale of an asset, when you've held it for a particular amount of time. Right. So now moving to the third point with respect to the registrations that you need in the tax kind registrations that you need.
The first, a couple minutes here.
Sure. The first registration that's relevant for this discussion is the permanent account number, which is the tax registration that you need. It's required for not only for your ability, it's pretty much required if you are going to have any income while you're being a resident. If you have any income in India, then you need this permanent account number. That registration is required. It needs to be quoted in various transactions, that the very specified transactions. It's required to be quoted. There's also, if you're going to, the period of stay is going to be more than 182 days, then you also a foreigner is also required to register with the foreigners regional registration office. That's another registration that is required. India also has a unique ID system which is called Aadhaar. If you're a resident in the country, then you're required to get that registration also. If you're not resident in India, then that's not a compulsory registration that is required. With respect to bank account, now we already explained, now that's where the play of your residential status as per exchange control regulation comes into play. If you have moved into the country, but you're still not a resident in India because you've not come for employment or a business or anything that shows that your stay is uncertain, then there's pretty much only one kind of account that you can have, which is called an NRO account. There are certain restrictions with respect to remittances that you can make. Pretty much Indian income, Indian or foreign income, you can all get into that account. Remittances abroad are allowed. Current income, you can completely remit out. If you have a salary income or any other interest income, which is a current income, you are allowed to remit that. But other incomes, there is a limit of $1 million US every year. That's the only remittance that's permitted outside the country. If you have moved into the country and become a resident in India, then you can have any other account like any other Indian, any other resident. There are certain schemes with respect to remittances there also. It's not freely remittable, But if you are earning a income from a salary from employment, that is freely remittable. In fact, you can actually get the credit of their account in an overseas account directly. That's not a problem.
Fishwash, can you
Um,
just wrap up there? We're running out of time.
Sure. So I'll just take a minute now. So the last point is with respect to if you're a non-resident from an exchange control perspective, there would be other limitations. There will be limitations with respect to your ability to acquire immovable property in India. There are rules with respect if a non-resident is investing into an Indian company. There are rules with respect to valuations, sectoral caps, etc. Those will be applicable. But if you move into the country and become a resident, then those things would not be applicable on you. And there are various planning opportunities available in all these issues. Thank you so much, and sorry for running off by
No
a
problem.
minute or so.
Thanks, Fishwash. And now we're going to move to Israel, and Elan Benelli is in Tel Aviv. And Elan, we'll move on to your section here. You're on mute still, Elan.
I see that. Okay, thank you very much, Warren. First, for those of you that I didn't have a chance to meet or exchange emails or talk on the phone, my name is Ilan Benelli. I've been a partner with Andersen since 2017. Prior to that, I was a partner in one of the big four in Israel. Personal PCS tax issues in Israel. We are a worldwide tax system. Warren, if we can move to the graduated tax rates. Our ordinary income and income on unemployment is relatively high. It's 47%. And if you can see in the bottom, we also have a wealth tax that kicks in relatively low. We put here 650,000 Israeli shekels, which is around $200,000. So guys who make more than that, they actually pay 50% of their ordinary income. Capital gains are taxed at 30% if you own more than 10% in the company. It's reduced to 25% if you own less, and the same applies to dividends. If we can move to the next slide. I wanted to highlight a few things that I think pretty much repeat themselves as we advise clients and potential clients. Warren mentioned that it's expensive to live in Canada, but very cheap to die. In Israel, we also don't have estate taxes, so no tax imposed when you die, or if you give a benefit, a present to a tax resident of Israel. It's different if it's a non-Israeli tax resident. But it can be also very cheap to live at the same time. If you come under this exemption, we do have a 10-year exemption for people who move into Israel or Israelis who left Israel for more than 10 years and went back to Israel. And this has been in place for a long time now. Over 10 years, people throughout the world are taking advantage of this. We have a series of entrepreneurs, mainly in the high-tech industry, but not only, that as they see that they are about to go for an IPO in the world, it was mentioned a series of those in recent years and in recent months. So if they plan properly, they can come back to Israel and be tax-free on the capital gains. They can be tax-free on their dividends, and they can also be tax-free on income they earn outside of Israel. And some say that the special benefits under this 10-year exemption is even as important, with the fact that you don't have any reporting requirement for income that is earned outside of Israel for this population. So this tool, been used substantially in the last years. It's also been criticized very much, but whether it's good or not, it's definitely gave a boost to our economy with getting entrepreneurs and, as a result, companies moving to Israel using this tax benefit. So not everything is perfect in our tax system. We do have an exit tax rules, which is regardless of your citizenship. So if I live in Israel for many years, and then I relocate into the UK, and I own assets, including shares in a startup company that I founded, there is an exit tax in Israel. This issue is repeating itself with our entrepreneurs who are relocating mainly to the US. A typical scenario is that they set up an Israeli company or a US parent company, but with all substantial activities in Israel. Then they relocate to the US mainly because the funds send them to either expand the market or get some additional funding from international investors and US funds. It's in the last couple of years, we see a very fast secondary sale, meaning that they sell part of the shares and then they get into a double tax issue, because the claim is, at least the theoretical, is that exit tax is not protected by double tax treaties. It's the actual tax event occurs a minute before you leave the country. You live in Israel in this case, and then the income tax treaty doesn't apply to reduce them or the double taxation as a result of the Israeli tax on the capital gains and the residency tax. It's a big issue for us. We deal with it a lot. We have some unique solutions around that. We actually get a significant part of our revenues around that, and some of the transactions are sizable. We do have, I think, based on what I've seen globally, a relatively unique equity compensation to promote the high-tech industry. You will find yourself as an employee or as a senior executive in a company in Israel entitled to a 25% on your options or RSUs or restricted stock. It's a way to convert employment income that, as you saw before, is around 50% tax into 25% tax. Very popular in Israel. It does get a little bit more complicated if the person is relocating into Israel. It's not straightforward to get the person the special the 25% tax rate, and also
a minute left.
Yeah, and also when you get the person relocated outside of Israel, then you get into double tax issues around equity compensation. Trusts, I think we have a unique rule around it's enough that in one Israeli tax resident, a beneficiary in a trust, and it becomes under Israeli tax law an Israeli trust that is required to be registered in Israel and report its income. We've seen this a lot with the trusts, with one family member moving into Israel. So if you have a similar case, beware. It's a real issue that needs to be dealt with. And finally, we do have a set of preferential tax rates for companies, especially around high-tech companies, but it also comes with special rates for dividend, and the tax rate for corporate can go as low as 6% and a dividend as low as 4%, which makes it attractive to people mainly in the high-tech industry to try and utilize. Thank you very much.
Thanks, Alon. We're going to switch to the United Kingdom, and Julian Nelberg's in London. And welcome, Julian. And the floor is yours.
Thank you, Warren. So in the UK, we have quite high tax rates. So most types of income are taxed at up to 45%. So quite high, but not as high as Canada. Dividends at 38.1%. So if you have a client who receives lots of dividends, then they'll be better off living in Brazil, by the sounds of things, where there's no tax on dividends. Capital gains, we have several rates. So the basic rate of capital gains tax is 20%, but we have special rates to incentivize, or punish certain types of investments. So if you're selling a business, you can get a 10% rate if certain conditions are satisfied. By contrast, if you're selling residential property, then the capital gains rate goes up, so it's 28%. We also have, if you make a gift to somebody, then you're deemed to have sold it for market value. So you have a dry tax charge, a capital gains tax on gifts. We don't, unlike Israel, we do not have an exit tax. So if you're a resident in the UK and that you leave the UK, you don't have to pay tax on unrealized capital gains. So final bullet point here, inheritance tax. So this is effectively a gift and estate tax regime, but we call it inheritance tax. And it's 20% if you make a gift to a trust. You can make gifts to other people without tax, so they're generally tax-free, subject to certain conditions. So 20% on gifts to trusts, and then 40% when you die. But the estate tax generally only applies if you have a strong connection with the UK, so i.e. you're domiciled here, or if you've lived here for more than 15 years. So like me, for example. So everyone else, they're still subject to the estate tax, but it's only on UK property. So next slide, please, Warren. So tax residency. So Warren was explaining earlier that in Canada you have like a common law rule for determining residency. So i.e. looking at facts and circumstances. And we had that here in the UK for many years, and it was quite complicated and quite subjective, difficult to determine if someone's resident or not. Because of that, a few years ago, the government introduced a bright line test, which basically it requires you to look at various factors, but it does give you a very certain outcome, so you can know for definite whether or not the client is going to be resident in the UK. And it's looking at things like, for example, if they're here for more than half a year, they will definitely be resident. If their main home is in the UK, they're resident. If they have full-time work in the UK, so it's things like that. But it's very important for anyone coming to the UK to actually determine the residency start date, because generally speaking, if you're going to do planning, it needs to be done before the person becomes resident in the UK. I said before we have quite high tax rates, but as many of you will know, we have a special tax regime to encourage foreigners to come and live in the UK, and it's called the non-dom regime. And basically, if you are from another country and you don't intend to remain here permanently, then you can generally benefit from this regime. And the way it works is that you're basically exempt from tax on income outside the UK, provided that income is retained outside the UK. So if you have clients that move to the UK and start bringing money in, that generally triggers tax. And that's why it's important to do planning before the client has moved to the UK, to basically get the maximum possible benefit from the non-dom regime. So in terms of the kind of most common pre-residency planning that we do for clients, first step is figure out, is the client non-domiciled? And if they are, what do they need to do to make sure that they will remain non-domiciled when they're here? And then once we've established that, it's really a question of making sure the client understands how to avoid triggering unnecessary tax while they're in the UK. And what that generally means is don't just go and willy-nilly transfer offshore funds from, say, a US or a Canadian or Israeli bank account to the UK, because that might trigger tax. And you can set up special structures that will enable the client to bring offshore funds to the UK without tax, but that has to be done before they've actually moved to the UK. One of the most common problems we see, this is the third bullet point. We don't have an automatic, unlike Canada, you don't get an automatic basis uplift for your assets when you move to the UK. So if you were to sell an asset and bring the money into the UK, you pay tax on the whole gain. But it can be possible to do planning to basically trigger an uplift in basis. But again, that has to be done before the client comes to the UK. The fourth bullet point on this list, so trusts and closely held businesses often cause problems because if the client has set up a trust, or if they have a business that they own or they control, when the individual moves to the UK, that can actually drag the trust or the business right into the UK tax net, so that the trust or the business would become subject to UK tax on all of its income, so would not benefit from the non-dom regime. Again, this is something that needs to be identified before the client has actually moved to the UK. And the final bullet point on here is just around the key planning milestones for people coming to the UK. And it used to be possible for a non-dom to come and live in the UK and benefit from the special tax regime indefinitely. So it could be 10, 20, 30, or even 40 years. And in fact, it was quite common for individuals to do that. And so there was a lot of political upset about this. And a few years ago, the government introduced a new regime that basically says that once the client's been here for 15 years, they're treated as if they were British. So they just become subject to UK tax on worldwide income, just like me. And then we also have a couple of other milestones, which is 7 and 12 years, after which the client has to pay an annual charge to the UK government in order to get the benefit of the non-dom regime. And then for each of these milestones, there are various planning things that clients typically do. But as I said before, it needs to be done before the event. I've actually finished ahead of time. So I think now we will move on to my colleague Debs in New York.
Just before I get Deborah started, thank you very much, Julian. And I was going to say is that the 7, 12, and 15 years, these key planning milestones, are those milestones or millstones?
They're milestones.
And I want to
millstones.
encourage participants to ask questions. You're welcome to do that. There's a button on your screen there that says you can submit a question, and we'll have some time for that at the end. And without further ado, Deborah Corrado is in New York, and you're the last but not the least, Deborah.
Thanks, Warren. Do you want to go to the first slide? Thank you. So the US has a federal and state tax regime. On the federal side, there are graduated tax rates that go up to a top tax rate of 37%. The amount of income that you'll hit that tax rate at will depend on your filing status, because in the US we have different filing statuses depending on whether you're single or married. We do have a 20% tax rate for certain types of income. So that is for long-term capital gains. So that's capital gains on assets held for at least 12 months. And for anything that's a qualified dividend, which is broadly most US dividends and then foreign dividends that are registered on exchanges such as the FTSE. The states, majority of the states do have an income tax as well. There's a couple of states that don't. Primary ones that we tend to see our clients favoring are Florida and Texas. The state tax rates do range from all the way up to, it's actually closer with New York State and City to 15% now. And the two notable ones that are considered the most expensive states are California and New York, especially if you're a resident of the city. We also have a social security tax, which is 7.65%. That is capped at around $135,000 of income. But there is what is known as additional Medicare, or sometimes gets called the Obama taxes, because they were introduced when he was in office. And that is broadly an additional 3.8%. It's a different bucket depending on whether you have investment income or self-employment income. We also have an estate and gift tax. It's a 40% tax, and it's very quick to get up to that 40% tax. There is, however, an exemption. If you are considered a US domiciled person, you have a unified exemption for gift and estate taxes of approximately 11.8 million. So what that means is you use that up with gifts during your lifetime, and anything that's left gets carried against your estate when you die. If you're not considered US domiciled, that is actually an estate tax exemption of 60,000. So it's very key, as I'll go on to talk about, to understand your domicile position. Some states also have gift tax, such as Connecticut, and estate taxes. I'd be remiss if I didn't draw attention to what's very hot in the US at the moment, which is President Biden's proposals to overhaul taxes, which were released at the end of April, and the Green Book, which was released a couple of weeks ago. There's many changes being proposed, but the key ones would be that the top tax rate would be overhauled to 39.6%. There would be no capital gains rate if your income is over 1 million, so there would be no preferential 20% rate. It also brings in proposals to remove the carried interest treatment that we have clients using, where they, without going into too much detail, they can categorize their income as long-term capital gain. And essentially that would treat that all as ordinary income, taxed at 39.6 when you're over 400,000. The Biden proposals did not include anything in terms of estate and gift tax planning, but it is worth noting that the 11.8 million joint exemption that exists will sunset in 2025, so we'll go back to closer to 5 million. And lastly, we have a corporation tax rate of 21%, plus applicable state rates, and Biden has also proposed to increase that rate to 28%. Do you want to go to the next slide, please, Warren? Thanks. Okay, so we summarized the sort of top 5 issues that people might want to think about before coming to the US. The first one is really knowing what your US tax residency position is. If you're not a US citizen or a green card holder, then whether you are a US tax resident will be based on the number of days that you are spending in the US. We have a test that sounds similar to the one that India has. Broadly, it's once you trigger 183 days, but it's not just in the current year, it also looks back at your prior 2 years. So when you're actually about to arrive in the US, it's probably key to look back at the number of days you've spent here previously to determine when you would trigger US residency. The reason this is key is because once you're a US resident, you're taxable on your worldwide income. However, to the extent you're still considered a non-resident of the US, you are only taxable on anything that is considered US source income. So, you know, some key planning maybe for people arriving later in the year. Do they want to try and keep their non-resident status for that first year and only be taxable on anything that's US source? As I said, the key here is knowing kind of what your residence position is. And one thing to note that I touched on earlier is that your residence position for gift and estate taxes is not on a days test. That's done looking at your actions. And broadly, you become US domiciled based on your intent and your presence. So once you shift your intent to be to the US, and one of the key things could be getting a green card or severing ties with your home country, then you would be considered US domiciled for estate and gift tax purposes. Again, something that we talk to clients about all the time, both when they arrive and, you know, once they've been here for a number of years. So other things, as well as knowing your resident status, that you can think about is accelerating or deferring income. So if you're moving from a country with a lower tax rate, then you may consider if you can accelerate income so that you receive it prior to coming to the US and becoming a US tax resident. So if you have, for example, dividends in a closely held foreign corporation or any deferred compensation from services that were performed outside the US. On the flip side, if you're coming from a country with a higher tax rate and you won't pay tax in that country once you leave, you may consider deferring the recognition of income. It may be tricky. You might not be able to control the timing of income. So, you know, one of the other things to think about is any assets you have. Can you time sort of when you realize the gain or potentially a loss? There is no step up in basis when you come to the US. So you may want to consider selling securities prior to coming and possibly buying them back to purge any potential taxable gain. However, if you've got assets with losses, you may want to consider holding on to those until you come to the US and then realize those losses after becoming resident, because capital losses carry forward indefinitely in the US. So even if you can't use them in a particular year, you may carry them forward to a future year. Number 4 is a key area that it's always good if we can talk to clients before they come to the US about, because the US has a number of regimes that apply to foreign holdings. So unless it's stock in something that's registered on a foreign exchange, you could end up in one of these deferral regimes. And there could be adverse tax consequences, such as gains on exits being taxed at ordinary rates, yearly income being taxed even if it's not distributed, and interest charges applying. And aside from that, if you own any of these sort of assets, there's also onerous reporting that it's crucial to get right, because the penalties associated with failure to file or forms or to disclose correctly are very high. And that's where we often pick up clients who've been in the US a number of years and have not reported some of these foreign holdings appropriately. There may be planning as well that could be done with the foreign holdings if you get to it before you come in the US. I mean, obviously, disposing of them might be a good planning technique, but sometimes it's not always possible to dispose of something, especially if it's, say, your business. So you might want to do something like forcing a deemed liquidation by electing to treat the entity as what we consider a pass-through for US tax purposes. It would mean the income would be taxed yearly in the US, but it could save you on some of the onerous reporting. And then the final one is obviously looking at your estate and determining whether you want to gift any assets prior to coming to the US, so you don't use up sort of any of that US estate and tax exemption that exists. And so, you know, you might want to think about removing them from your estate at that point. We sometimes see people putting assets in a trust prior to arriving in the US, but you should seek planning before you do that, because there are income tax implications of doing that for the first 5 years that you live in the US.
Outstanding. Thank you very much, Deborah. I think that's our last slide. I want to encourage people. We didn't actually get any questions from the audience, which means we answered all the questions. But there's a couple themes I want to draw from and just kind of talk among the panelists here. One was tax residency, where I know in the US and also in the UK, you kind of have an objective test of residency. I mentioned Canada has a subjective test of residency. And that creates uncertainty because you can end up being a dual resident, even where there's objective measures. Uncertainty can create tax planning opportunities or tax planning problems. I'm just wondering if particularly the US and the UK, if you want to comment on that. And even Brazil, because I noticed you've got you needed a visa to become a tax resident.
Well, I might have some considerations on that. I might be stepping up before Deborah and Julian. I apologize, but it's a funny conjunction of jurisdictions we have here in this panel, because on the Brazilian side of things, we hold treaties to most of you. So we have treaties, treaties to avoid double taxation with Canada, India, and Israel. We do not have proper treaties with the US or the UK, but we hold a reciprocal treatment. We take advantage of their local laws to use foreign tax credit, and we do the same. So in Brazil, we could minimize things, both using the treaties and also this reciprocal treatment, which is quite nice. And it's a coincidence ultimately, because we don't have too many agreements. India holds a lot, I know, and maybe Vishwas could extend his explanations on that, but we hold only 33, which is a shame. But I'm sorry, I'd like to see the comments from Deborah and Julian also on that.
Yeah, I mean, I think to your point and to Warren's point, ideally when someone's making a change of country, they're not planning just with the one country. You need to look at both sides of the coin, both so you don't end up in a double tax position, but also to if there is anything that you can exploit to end up in a no tax position. And the treaties that exist are a vital point of that. And if you have somebody that could end up resident in both places or could end up with a double tax on the domestic law, then you'd ideally seek to use a treaty to mitigate that.
I mean, from my experience, we like to try and use the UK domestic law first without having to rely on the treaty, but it's very, very helpful where you have got a treaty to go to in the event that you did have a double tax scenario. It's probably worth saying, I mean, there are some situations that even where you have got a treaty, you can end up with double tax. And one scenario we see very often is where people come to the UK and they hold shares in a US LLC. And it's one of those things that kind of falls between all of the gaps, and these individuals can end up paying tax twice on their income from the LLC. So I think the message is, just because there is a treaty doesn't mean you can assume that there'll be no double tax problems.
Yeah, the other thing I wanted to note in our conversation here is the opportunities for high net worth individuals. And, we talked about that with respect to Canada a little bit, that Canada doesn't tax pre-immigration gains. The UK has a non-domicile provision, which I was aware of. I was not aware that Israel provided a 10-year exemption on income tax. And what we're seeing is not only these countries, but other countries as well, seeking to attract high net worth individuals. And Switzerland and Italy are two examples of that. But Ilan, you mentioned that Israel has seen a substantial number of people, I presume, come to Israel with high net worths, and how is that work both from a tax perspective and also politically? You're on mute, Elon.
Okay. So from a tax perspective, we get so many approaches, and a similar scenario. You can have, whether it's an originally Israeli person or not, who set up a US company, and if they raise money and the company progresses and the value of the shares appreciate, and then they see a potential M&A or they see a potential IPO, we see these guys moving back to Israel. And if they don't have a US citizenship or green card, they can be in zero tax. I've been involved in a number of these situations where people with gains of over $100 million find themselves with zero taxes. So that's definitely a tool that is being widely discussed and used on cross-border issues here in Israel. On the political side, it's a huge issue because I don't want to get you too much into the Israeli politics, but we just changed government, and our long-lasting prime minister stepped down. Some suggest that this was aimed at a couple of very influential people who are related to politicians that triggered this tax, and this is part actually of a court case of a bribery allegation against our prime minister or former prime minister. So it's definitely a big, there's a big tension around this law, but whatever the reason they enacted it, it's been widely used and still used.
Thank you. Julian, did you want to talk about, is London still a destination for high net worth individuals?
Well, right now it is, Warren, very much so. Yeah, very much so. I mean, we're hoping very much that the government doesn't do anything with the non-dom regime that we have. It's a very attractive place to come. So they certainly haven't said that they would change it.
And Daniel, zero tax on dividends, that's a pretty attractive provision too.
It is, right? So it works. It's been working. But that applies to Brazilian companies alone, right? So if you have, say, a foreign vehicle or an LLC, unless you distribute, you also don't have any income taxes in Brazil. So even for Brazilians, they opt to have that intermediary vehicle holding investments and postpone the taxation here locally up to the point that this is actually distributed to the stock owners, to the shareholder.
Excellent. Well, I want to thank all the presenters here for taking the time out. I want to send a special thanks. You can see on your screen there, Krista Rabideau is a partner in our Canadian firm, and Nicole Elzinga. They've been doing kind of the technical backup here to make sure that we're online and coming through to you clearly. So thank you for getting up at about 5 in the morning here in Vancouver. It's a little bit earlier. The sun's coming up. You can see my face is a little bit brighter here. I know the day is ending for some of you, some places. Thank you very much for joining us. Please do complete the survey. It'll be sent to you or show up. I know it's going to do that somehow. I think Nicole's in charge of that. And feel free to reach out to any of the members here. We look forward to meeting you personally in Las Vegas, but also doing future webinars on subjects that would help you in your practice and build our private client service team worldwide within Andersen Global. It's great to have you online here. And thank you very much for everyone. And we'll look forward to seeing you next time.